Hello dear friends, welcome back to Rugged Capitalists with a new video. This video tells you about stock market investment and gambling differences. Today, many investors debate that investing in the stock market is like gambling at a casino. This is the opinion of many investors who believe they are not investing but simply gambling in stocks. Gambling is quite like investing, it's a game of chance. What is true? No. However, there are major differences between gambling and investing. We will discuss the difference between gambling and investment in this video. Make sure to watch this video till the end and press the subscribe button on your notifications, and you update yourself with our videos. Okay, let's move toward the video. Investing versus gambling. How many times during a discussion about finances have you heard someone say, investing in the stock market is just like gambling at a casino? True, investing and gambling both involve risk and choice, specifically, the risk of capital with hopes of future profit. But the question is how much difference between them. Gambling is typically short-lived, while equities investing can last a lifetime. The stock market is not a game of chance like at a casino or racetrack. It's a place for investors to make money by buying stocks when they're low and selling them when they're high. Yes, it's a profitable game. While they might seem the same with some types of market trading, investing is all about taking calculated risks with your money. Gambling, on the other hand, is a zero-sum game where anything you lose the casino wins. There's no gray area on possible outcomes and shared wealth building. You can use gambling strategies to increase your chances of winning, but you're playing a game with defined rules and outcomes. So, you can imagine here, what is the best way? The stock market is a means for building wealth over long periods by taking available information and analyzing it to make decisions. The stock market is a means for building wealth over long periods by taking available information and analyzing it to make decisions. You can research stocks to determine the value of a company and its prospects. Further, you can limit your losses through risk mitigation strategies. Gambling doesn't allow for such decision-making. In short, the stock market is not gambling. Investing in stocks isn't like gambling because there are rules for investing that can lead you to have higher returns than keeping your funds in cash. Investors who treat stock market trading like gambling run the risk of placing their money in jeopardy by missing out on gains or losing it altogether. Either outcome makes it difficult to retire comfortably or live the life they want. Investing in stocks involves managing risk and increasing your chance of profitable returns. It's not an easy task, but it can lead you to enjoy financial security in the future. Investing. Investing is the act of allocating funds or committing capital to an asset, like stocks, with the expectation of generating an income or profit. The expectation of a return in the form of income or price appreciation is the core premise of investing. Investors must always decide how much money they want to risk. Some traders typically risk 2 to 5% of their capital based on any particular trade. This, in essence, is an investment risk management strategy, spreading your capital across different assets or different types of assets within the same class will likely help minimize potential losses. To enhance their holdings' performance, some investors study trading patterns by interpreting stock charts. Stock market technicians try to leverage the charts to glean where the stock is going in the future. This area of study dedicated to analyzing charts is commonly referred to as technical analysis. Investment returns can be affected by the amount of commission an investor must pay a broker to buy or sell stocks on their behalf. Gambling. Gambling is defined as staking something on a contingency. It means risking money on an event that has an uncertain outcome and heavily involves chance. Most professional gamblers are quite proficient at risk management. They research player or team history, or a horse's bloodlines and track record. Seeking an edge, card players typically look for cues from the other players at the table. Great poker players can remember what their opponents wagered 20 hands back. They also study the mannerisms and betting patterns of their opponents with the hope of gaining useful information. Constantly change up until the race starts. Generally, the odds are stacked against gamblers. The probability of losing an investment is usually higher than the probability of winning more than the investment. A gambler's chances of making a profit can also be reduced if they have to put up an additional amount of money beyond their bet, referred to as points. Points are comparable to the broker commission or trading fee an investor pays. The time factor. Another key difference between the two activities has to do with the concept of time. Gambling is a time-bound event, while an investment in a company can last several years. With gambling, once the game or race or hand is over, your opportunity to profit from your wager has come and gone. You either have won or lost your capital. Stock investing, on the other hand, can be time-rewarding. Investors who purchase shares in companies that pay dividends are rewarded for their risk dollars. Companies pay you money regardless of what happens to your risk capital, as long as you hold onto their stock. Savvy investors realize that returns from dividends are a key component to making money in stocks over the long term. Getting information. Both stock investors and gamblers look to the past, studying historical performance and current behavior to improve their chances of making a winning move. Just the same as that of the other investors. Stock and company information is readily available for public use. Company earnings, financial ratios, and management teams can be researched and studied either directly or via research analyst reports before committing capital. Stock traders who make hundreds of transactions a day can use the day's activities to help with future decisions. Stock is ownership. Investors who invest in stocks of a company are buying ownership in that company. They have part ownership of the company. This means with every SIP investment you are earning more money. As you are a part owner, you have the right to claim on the assets and debts, also including the small fraction of the profits made by the company. Trading is a game of skills and discipline. Unlike gambling, trading is a game of skills that requires discipline and knowledge of fundamentals. In gambling, where the future is dependent on a spinning wheel, in trading, it depends on technical metrics like charts, trends, and patterns which help you make trading decisions. So, both ways, trading and gambling, have the same risk for you. But most people say the stock market is gambling. But it's not true. Stock market, all investors invest their money here and buy or sell their shares. Trading is a most profitable way than gambling, where you have more chances to profit your money. Successful investing is about managing risk, not avoiding it. At this time, give us leave and we will meet again with one new video. Make sure to press the like button.